think the Federal Reserve is still in control? You think when they cut rates, borrowing gets cheaper? You think when they signal relief, the pressure eases? You're wrong. And the part that should terrify you is that the people who move billions of dollars every single day already know you're wrong. They've already moved, they've already positioned, and you're standing exactly where they need you to be when this breaks. The Fed cut rates this week. The bond market looked at it and laughed. Not out loud, not dramatically, just in the way that matters. Long-term yields stayed high. Mortgage rates stayed high. Government borrowing costs stayed high. The Fed pulled the lever. Nothing moved. And if you think that's just a technical disagreement, you don't understand what you just witnessed. You just watched the bond market take control away from the central bank. In real time, in broad daylight, while everyone else was celebrating the rate cut. This shouldn't be happening. When the Fed cuts rates, long-term yields are supposed to fall. That's how the system works. That's how it's always worked. The Fed sets the price of short-term money. The bond market follows. Borrowing costs drop across the economy. Mortgages get cheaper. Companies refinance debt. Governments roll over obligations at lower rates. The signal flows smoothly from the central bank to every corner of finance. One lever, predictable results, controlled outcomes. Except the lever just broke. The Fed cut rates and mortgage rates didn't move. The Fed signaled relief and the 10-year Treasury yield held firm. The Fed tried to loosen financial conditions and the bond market kept tightening them. The message went out. The market received it. And the market said, "We don't believe you anymore." Think about what that means. Not theoretically, not in some abstract policy debate. In your life. Right now. If you're trying to buy a house, the Fed just cut rates and your mortgage costs stayed exactly the same. If you're holding bonds, the Fed just cut rates and your long-term holdings are worth less, not more. If you work for a company that needs to refinance debt, the Fed just cut rates and your borrowing costs didn't budge. The most powerful central bank on earth tried to help and the help never arrived. It stopped somewhere between the policy announcement and your wallet. Someone intercepted it. The bond market kept it. And they're charging you for the privilege. This keeps happening. Every data point confirms it. The Fed cuts. Long yields stay elevated. The spread widens. The disconnect grows. And every single day this continues. The Fed loses a little more authority. A little more credibility. A little more control over the machinery it's supposed to operate. This isn't a one-day anomaly. This isn't noise. This is a pattern. And patterns reveal intention. The bond market is testing the Fed. It's pushing. It's probing. It's asking. How much further will you cut before you admit this isn't working? How long will you pretend you're easing conditions while we're tightening them? How desperate will you get before you show us your real hand? And every rate cut that fails to transmit is another answer. Every yield that refuses to fall is another data point. The bond market is learning. It's learning exactly how much power the Fed has left. And the Fed is teaching it in real time. Here's what the bond market figured out. The Fed can only control the short end of the curve. Overnight rates, federal funds. The price banks charge each other for money they'll pay back tomorrow. That's it. That's the entire scope of direct control. Everything else, 10-year yields, 30-year yields, mortgage rates, corporate bond spreads, that's all determined by the bond market, by investors who have to believe the Fed's narrative about inflation, growth, and fiscal stability. And those investors just stop believing. They're looking at government deficits that never close. They're looking at debt accumulation that never slows. They're looking at interest payments on the national debt that are becoming one of the largest expenses in the federal budget. And they're connecting a very simple sequence of events. If the government keeps borrowing and the Fed keeps cutting rates to help it borrow, then one of two things happens. Either inflation comes back, or the Fed loses the ability to fight it. Either way, holding long-term government debt at current yields is suicide. So they're demanding more, higher compensation, bigger premiums, and they're going to keep demanding it until something fundamental changes. The Fed can't give them what they want, because what they want is fiscal responsibility, deficit reduction, debt trajectory correction, and the Fed doesn't control any of that. The Treasury does. Congress does. The political system does. And the political system isn't changing course. It's accelerating. Spending isn't slowing. Borrowing isn't decreasing. The fiscal path is set. And the bond market knows it. So the bond market is front-running the inevitable. It's pricing in the crisis before the crisis admits it exists. This benefits someone. It always does. When a system breaks down, the people positioned for the breakdown win. And right now, the winners are obvious. Anyone holding cash is winning. Anyone in short-term instruments is winning. Anyone who got out of long-term bonds is winning. Anyone who bet against the Fed's ability to control the curve is winning. They saw this coming. They positioned months ago. And they're watching everyone else, home buyers, governments, corporations, leveraged funds, absorb the damage while they collect the premium. The bond market isn't just rejecting the Fed's narrative, it's extracting payment for every day the narrative persists. Every day yields stay high while the Fed cuts is a day that cash holders earn more, bondholders lose more, and borrowers pay more. It's a transfer. A massive, silent transfer of wealth from the people who believe the Fed to the people who stopped believing first. And that transfer is accelerating. This hurts you. Personally. Immediately. If you're trying to buy a home, you're paying 7% on a mortgage in an economy where the Fed is cutting rates. If you own long-term bonds, you're watching their value erode while the central bank is supposedly easing. If you work for a company with debt to refinance, you're watching borrowing costs stay elevated while the Fed is trying to help. The rate cut was supposed to be relief. It was supposed to make your life easier. Instead, you're discovering that the Fed's power to make your life easier has limits. And the bond market just found those limits. And it's showing them to you in the most expensive way possible. Here's the mechanism that's killing you. The Fed controls short-term rates. You don't borrow short-term. You borrow for 30 years on a mortgage, for 10 years on a corporate bond, for decades on government debt. And all of those rates are set by the bond market, not the Fed. So when the Fed cuts and the bond market doesn't follow, you're trapped. You're trapped between a central bank that's trying to ease and a market that's tightening. You're trapped between policy that says conditions should improve and prices that say they're getting worse. And the space between those two realities is where you're being crushed. Every single participant in this system is feeling the squeeze now. Home buyers are locked out, sellers can't move, the housing market is frozen, builders aren't building, real estate wealth is trapped, consumer spending slows, corporations can't refinance, they defer expansion, they freeze hiring, credit tightens, growth slows, and the government keeps borrowing into a market that's demanding higher and higher yields to absorb the debt. The cost of servicing that debt explodes. The fiscal situation worsens, which makes the bond market more nervous, which pushes yields higher, which makes the fiscal situation worse. The loop tightens, the pressure builds, and everyone inside the system is being compressed, except the people who got out, except the people who saw this coming, except the bond traders who positioned for exactly this scenario and are now collecting premium on every transaction. They're not being squeezed, they're doing the squeezing. And they're going to keep squeezing until something breaks or someone capitulates. The Fed can't capitulate. If the Fed admits it's lost control of long-term rates, the entire framework collapses. Confidence evaporates. Markets panic, the currency comes under pressure. So the Fed has to keep pretending. It has to keep cutting short-term rates and hoping the long end follows. It has to keep signaling confidence while the bond market signals the opposite. It has to keep pulling levers that don't work and hoping no one notices they don't work, but everyone's noticing. The bond market noticed, the mortgage market noticed, corporate treasurers noticed, and now you're noticing. The Treasury can't capitulate either. The government has to keep borrowing. It has no choice. Deficits are structural. Spending is locked in. Revenue isn't covering obligations. So the Treasury has to keep issuing debt. And it has to issue that debt at whatever yield the bond market demands. Not the yield the Fed wants, not the yield the Treasury can afford, the yield the market will accept. And if that yield keeps climbing, the interest burden becomes unsustainable. The debt spiral accelerates. The fiscal crisis that everyone's been pretending isn't coming arrives. Not in 10 years, not in 5 years. In real time. This won't stop. Because no one can stop it. The Fed can't force the bond market to lower yields. The Treasury can't force investors to accept lower compensation. The government can't force the fiscal situation to improve without political changes that aren't happening. So the machine keeps running. The Fed keeps cutting. The bond market keeps demanding higher yields. The gap keeps widening. The pressure keeps building. And every day this continues, the system gets weaker, more fragile, more vulnerable to the shock that finally breaks it. The next Treasury auction is that shock, or the one after that, or the one after that. Billions of dollars in government debt will be offered to investors who are actively losing confidence in the government's ability to service that debt. And those investors will decide what yield they need to take the risk. If they demand too much, the auction struggles. If the auction struggles, confidence cracks. If confidence cracks, the next auction is worse. And the Fed is standing there watching, unable to intervene without admitting it's intervening, unable to let the auction fail without revealing the system is failing. The bond market knows this. The bond market is counting on this. Every auction from now on is a stress test, not of the Treasury's ability to sell debt, of the Fed's willingness to abandon its narrative and start buying debt directly to keep the system functioning. And the moment the Fed does that, the moment it announces yield curve control or quantitative easing or whatever term it uses to describe printing money to absorb what the market won't, the bond market wins. Completely. Permanently. Because then everyone knows. The Fed isn't in control. The bond market is. And the Fed is just doing what the bond market forces it to do. You're living through the transfer of power right now. From the central bank to the market. From policy to price. From the institution that's supposed to control the cost of money to the collective judgment of investors who've decided that institution can't be trusted anymore. And this transfer isn't theoretical. It's not academic. It's happening in the mortgage rate you can't afford, in the bond price that's falling, in the Treasury yield that's rising, in the corporate debt that can't be refinanced, in every single corner of the economy where long-term borrowing happens and the Fed's rate cut doesn't reach. The system is splitting in half. Short-term rates are falling because the Fed controls them. Long-term rates are rising because the bond market controls them, and the gap between the two is growing every day. That gap is the crisis. That gap is where the real economy lives. That gap is where you're trapped. Between a Fed that's cutting and a market that's tightening. Between relief that's promised and pressure that's delivered. Between what's supposed to happen and what's actually happening. The Fed thought it could guide the economy by adjusting interest rates. The bond market just showed it that guidance only works if the market agrees to be guided. And the market stopped agreeing. It stopped following. It stopped believing. And once belief is gone, all the Fed can do is react. Cut faster, cut deeper, signal more urgency, show more concern, and every signal of concern confirms what the bond market already knows. The Fed is worried, the Fed is behind, the Fed is losing control, and when the Fed loses control, yields go higher, not lower. Conditions tighten, not ease. And the rate cuts that were supposed to help make everything worse. You're watching monetary policy eat itself. The Fed cuts rates to ease conditions. The bond market interprets the cuts as desperation. Yields rise, conditions tighten. The Fed cuts more. The market gets more skeptical. Yields rise further. Conditions tighten more. The cycle feeds itself, and every iteration makes the Fed weaker and the bond market stronger. Until the Fed has no credibility left. Until every cut is seen as panic. Until the market stops pretending the Fed matters at all. We're not there yet, but we're close. Close enough that the next few treasury auctions will tell us everything. Close enough that the next batch of mortgage data will confirm whether this disconnect is temporary or permanent. Close enough that corporate credit markets are starting to price in a world where the Fed can't rescue them anymore. Close enough that the people moving real money are positioning for the Fed to fail, not succeed. And you're on the wrong side of that positioning. You're holding assets the Fed promised to support. You're planning around conditions the Fed promised to ease. You're trusting an institution the bond market just stopped trusting. And the distance between where you are and where you need to be is measured in basis points that are moving against you every single day. The Fed cut rates. You didn't get relief, you got a lesson. A lesson in who actually controls the price of money when the system disagrees. And that lesson is being delivered in the most expensive classroom in the world. Your mortgage, your bonds, your borrowing costs, your trapped equity, your frozen plans. The bond market just reclaimed control. And it's sending you the bill.